Hi, it's Jeffrey Cohen, President and founder of U.S. Advanced Computing Infrastructures, Inc. We are an Illinois registered investment advisory firm, as well as IT consulting. So wanted to give you a quick call and make a video and talk about the latest article. We see a storm cloud for U.S. equities far in the distance. So what does that mean? And by the way, go ahead, ask me anything. So what does it mean? Well, for a very, very, very long time, we have been talking about variance in stock prices. And so variance has been going down. Variance going down is a really good thing. I got a whole page on it. I mean, we've been doing it. We've been tracking this stuff for over a year. And if you look at the S&P 500, the variance has dropped about 40%. And if you look at all the stocks that we track, maybe 35%. So variance has been lower. That has fueled a stock market rise despite higher interest rates, struggling economy, all those crises we have. Doesn't seem to matter because when stock price variance falls, people are more confident with new money to put it in. And so that's been great. That's been a real tailwind for the stock market. And it's the reason why we haven't poured a lot of money in the market, because the fact that stocks are less risky doesn't make sense on Main Street. Like if you ask the average person, so do you see a lot of risk in stocks? They'll be like, yeah. If I said, what if I told you it was 40% less risky than a year ago? No. So it's a little counterintuitive, but it's what we found. So I got to tell you, right? And by the way, I hope you like my Jimmy hat. Reason I'm wearing it, I just went to the doctor and I got some splotches on the top of my head there that the doctor made. So I don't want to show you. So I'm putting on my Jimmy hat, which I bought in Scotland and I think is terrific. So what are the storm clouds? Historic volatility for all stocks that made it into our model. So there's like 3,000 of them out of the 10,000 that trade. 3,000 of them, it went down. I'm sorry, the volatility went up. The volatility rose. It was a small rise. It was a typical size rise. So we're not talking about an amplitude anomaly or a size. We're just talking about direction. It's kind of like you roll a die and you've been getting ones for a year. And now you get a two. All right. Or you're flipping a coin and you've been getting heads for a year and then you get a tails. So it's not an amplitude change. It's not like you got a 2.5. It's just another number. Technically what it means that yesterday and for the past year behind it, stocks had more price movement. The movement was more movement. It's not to say that they didn't go up, they didn't go down, but there was more zig and zag in the movement. So, what does it mean for investors? Are these storms that are right on your head? Or are they storm clouds in the distance? I like to think of them as storm clouds in the distance because we don't know what's going to happen. Even this, it looks like the storm is over the city. I'd like for the storm to be a little bit more in the distance. Cloud should not really be overhead. There you go. There's a storm over the Atlantic, and you're in New York City. How's that? Maybe this is just over Puerto Rico. You see it, it may not hit you, but you're not sure. And so that's when I think about this storm, what I think about. I think about a storm in the distance. I love that picture, though. It's not really a storm. And that's a good one because it shows, hey, it's coming. You got to be ready for it, right? So let's see if I have the one with the Gulf of Mexico. Maybe not. So I was going to show you what it looks like. It's real fabulous. So we run our model. Ooh, make it nice and big for you. By the way, people pay money for this. Not a lot of people, but some people. So the variance of the S&P 500, market through 1010. The S&P 500 variance was 2.031. Do I have another one of these? The market through the day before, through the 9th, was 2.2039. So in fact, the S&P 500 variance is still falling. Okay, so the index still looks good. In fact, look at that rate of return. The expected market return based on the index and the risk-free return is now 9.25. It was 8. It was 8 2/3. And that's because the IWM, or the Russell 2000, has been breaking up out of zero, basically out of flat for the year. And you can see S&P 500 is up 18.25 versus 16.5. QQQ is up 32 2/3 versus 30 7/8. So the market was up yesterday. And so the S&P 500 variance was down. For most people, that's enough to say, yeah, we're good. But now we saw something. 2,984 stocks pass their data validation. Variance, 3.606. 2,983 stocks, data validation. So it's close, within one. 3.593. So the minimum we've seen is 3.593, and it's up to 3.606, times 10 to the -5th. You can see, though, that the expected return is higher. The CQ&S power is higher, and that's because the market's been screaming higher, which is great, You know, you look at the market and you think, oh my goodness, we made so much money in this market. This is a great market. I'm making so much profit, I can't even stand it. And you'd be right. Look at this thing over a year. The Russell is up 6%. The S&P 500 is up 20. The Nasdaq's up 39 for a year. That's great. Those are great returns. So your question is, what about variance? And so we see variance now starting to rise for the first time for stocks. That's interesting. Market looks great, right? Now the funny part is the market's up. It kind of plateaued at the end of July, plateaued here in the middle of July. It looks like it's been kind of making like lower lows, lower highs, lower lows, lower highs, which is never a good sign. But at this point, we're starting to see some chop, mathematical chop. And the market's still screaming, go higher, go higher, go higher. But it's the first issue, variance. So let's take a look. What do we got here? Like, what's the best portfolio? You're not going to be surprised because it's going to be the same risky stuff, right? Affirm Holdings, Cardlytics, Open Technology. It's actually Open Door Technologies, which is therapeutics. TNA, PACW, Select Quote, Comp. I don't know what Comp does. The other ones I track. A lot of risky stuff. Upstart, Carvana, Skills. By the way, we're long Skills. We hold Skills. We like Skills. Skills is a top performing stock individually in the model. We like it a lot. We're in it. Apps, Digital Turbine. We're not in it, but we want to be in it. We like that stock. That stock is also rising, a rising star in the model. And so lots of interesting stocks to look at. But it's saying to have these tiny portfolios. 1, 2, 3, 4, 5 stocks gets you 39 to 50 ticks of edge. So just buying and holding a firm gets you 50 ticks of edge over the S&P 500. That's crazy. So this is what happens when the market just screams higher and variance goes lower. It makes sense to buy more. Market's going up, risk is going down. Why wouldn't you buy more? So we saw a first risk. So let's take a look at the VIX. The VIX told us something a little odd. We'll bring back Koi Fin. I like Koi Fin a lot. Let's take a look at the 10-year VIX. Okay? 10-year VIX has been pretty much flat around. Looks like there's a trend line. I don't want that. I want this. Just the VIX. The VIX screamed higher right around the COVID time. And has been elevated and has been down now. So we like it when the VIX is down. It means, so when the VIX goes down, when the cost of insuring your stocks goes down, you're willing to buy more stocks because you could put $1 billion borrowed 10x, $100 million buys $1 billion of stock. You stick it in a vault somewhere, you get your dividends, and then you buy some insurance. And the insurance allows you to sleep at night. If the insurance is cheap, the market can go up and everyone can rest easy. And what happened is, if you go back the last 5 days, so the market, it's gone a month. The VIX has gone up. So what that means is that the price of insuring against risk has gone up until right around the beginning of October, October 3rd. It's been falling since. It is up. Over the 3 months, over the year, you can see it was much higher a year ago. Came down, and it really has kind of retraced some of its losses. I don't know what to say. So VIX is not necessarily screaming higher. I guess the people that buy and sell options haven't watched this video yet. It's funny, we just made the video, so that they can't see it, right? If we look at the VIX, maybe in a simpler way to look at it, a nice, tight, FinViz visualization. And you see the VIX here has been higher, has been lower, right? It really helped us June through beginning of October for the market really to hang on with rising interest rates. And suddenly now, popped up to the 20s. It's back down to 17 handles, but it's like 17.05. So I don't know. What's that mean? It means the VIX responded sort of over the past few weeks. And that's interesting to me. It's very interesting to me. Why is that interesting to me? Because it means that the overall price of volatility or price to protect your stock portfolio has gone up lately. And so that's what we would look for. Now, there's a serious negative inverse correlation between stock movements, stock price movements, the S&P 500, and the VIX. So if we look at market information and we look at negative beta stocks, by the way, Chicago Quantum is the home of the negative beta stock list. Learn more about our blah, 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 right? Blah, 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 buy, 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 right? But let's just look at this, because I'm not here to sell you anything. These are our negative betas. VIX funds. Short-term VIX has a negative beta of 2. Short-term ultra, or leverage 2x VIX, has a negative 3 beta. So what that means is that when VIX goes up, it just so happens the stocks go down. VIX is the implied volatility or the cost for risk moving forward. What we're telling you is we see historic volatility. And we see that historic volatility changing. I do like this picture. It's enough in the distance. It's fine. So where's my other text edit? There it is. So we see just a little volatility. It's not even close to outweighing the rise in the stocks. The stocks are screaming. This CQN has power of almost 6, of 5 2/3, 5.5. This is the one on the right is like 2 days ago market. The one on the left is yesterday's market. 15.7, 16.5. You might argue that this is the climax of the stock market right now. I don't know that that's true. It's just a sign. It's just a storm over the Gulf of Mexico, and you don't know whether it's coming to New York or not. You really don't. So what do you do about it? Well, the model says go and buy the riskiest crap you can find. Holy cow. But I'll tell you what else the model gives you. The model gives you some stocks that, excuse my language, these things are dog shit. And in fact, one of them we were tracking recently. We almost bought it when the market was really frothy. Because I got to tell you, nothing smells as good as dog shit when everything's going up. Because when everything's going up, the crappiest stocks go up the fastest. So, Fortress Biotech, it's a 29-cent stock, a 30-cent stock. Second worst performing stock, according to risk return. You got Micro Mobility, which is a $217,000 company. I don't know. If you had $100,000, MCOM, you could probably make quite a splash. Let's see. Can I make a splash with MCOM? Probably. Is it even a thing? It trades. It made data validation. It trades. Look at this thing over a year. It's 3-cent stock, 4-cent stock, but it traded as high as $21. It's traded 54 million shares today. It's a 4-cent stock. It was $21. You don't think for a minute that this stock is exciting? Of course it is. It's the worst. It is the worst stock in the Chicago Quantum Net Score. It has more volatility and less kind of go with the flow than any stock. I love this stock. It says there's $10 million. Intrinio says it's $217,000. It doesn't matter. They probably did an offering or 100 offerings, and who knows. But wow. I love it. So the model says this is the worst. Oh my God, there's warrants on it. Micromobility.com warrants for $0.015. So if you didn't want the 4-cent, all right, but you see what I mean? The model gives you the stocks that are like really risky. Mullen Automotive, Faraday Future Intelligent Electronics, Big Bear AI, FiberGen. These are stocks. These are like the worst, the riskiest. Tilray Brands, which is a good cannabis stock. Magical Pharmaceutical, which went up to the moon. Now where does it go? Arcit Quantum, which does actual quantum communications and security. Lots of interesting things here. Personally, I'm excited about MCOM. I might buy a little before 3 o'clock just to see what happens. Wow, is this thing crazy? So, all right, thanks for watching. This is, I better get going and maybe buy a little bit of that. That's cool. So, but there's storm clouds and there's crappy stocks. This is the worst stock. Worst stock ever. And so, and there it is, and you could see why, right? Because there's people who bought it at $6, $7 a share, and now it's at 4 cents a share. Oh boy. Down 8% today. Love it. All right. Well, so what I was trying to find though is when you look at the S&P 500, are we at a top? Are we at maximum velocity? No. It was 4,600, but it might be that for the market to move either higher or lower, it needs to get a little jittery. It needs to get a little excited. The math has to throw off some changes, right? And so there's another way to look at this. So the S&P 500 is not a good way to look at the market. It is not fair. It's not fair at all. And the reason is that the S&P 500 is market capitalization weighted. I know I've explained this a million times. One more time. So market cap weighted means that a stock that's worth $100 is 100 times more present or represented than a stock that's worth $1. So if you have a bunch of stocks that are $1, and then you have like one stock that's $100. So let's say you have 100 stocks, 101 stocks, and I got to do an S&P 500. And I got to do an equity market cap weighted. 100 stocks, they're each trading at $1. One stock that's trading at $100. You're going to have like $50 invested in the one stock and $1 or 50 cents invested in the other 100 stocks. So it's not really fair. So let's take a look at this as a bubble chart. Not the S&P 500, but all of them. And we're going to look at the largest because 10 billion and above probably is what it takes to even get into the S&P 500. And you can see these stocks don't really move. But when they're moving up. Now, there's some oil stocks that are down. This is in one day. Let's take a look at change over a period of time, over a year. What you see is very few stocks that are worth a lot of money have gone down over a year. Very few. They've gone up. So in fact, if I do this minus 40%, 40.5 to 40.5, just to try to get it clean. Clean it up, Jeffrey. Clean it up. You can see that there's many more stocks above this dividing line than below. So the S&P 500 is buying the stocks and holding the stocks that go up. It's not a bad strategy, right? Buy high, sell low. Buy the biggest, baddest, most successful stocks. If a stock goes down, sell some of it. If stock goes down a lot, sell all of it. Most of it, right? Stock goes up, buy more. So you can see Amazon is up 15% on the year. Apple's up 27%. Berkshire Hathaway's up 30%. Toyota's up. I mean, they're all up. Come on now. Even Taiwan Semiconductor. Tesla. There's stuff missing here. Just gotta be. But point is, that's not a fair model. So what we do, we have a proprietary thing we do. We take all the stocks that we ran. This is yesterday's run. We look at the market cap, which you can see is not perfect. But at least if Intrinio has errors, they're consistent errors. And you do a sum, and you got $50.2 trillion. $50.2 trillion market cap. Total market cap. 50.2 trillion. Now that has jostled around a bit. It's been as low as like 46 since we've been looking. It's never really been higher than 51. So the market valuation of stocks, despite the fact that the S&P 500 seems to have balanced out over the year, it appears that valuations of stocks may be at their high. So the big cap stocks went up here, but maybe all stocks are highest here. I don't know about you, but seems like a good time for the market to be a little scared maybe. $50 trillion market cap. $50 trillion market cap. Volatility just started to increase yesterday. So, is this a storm on the horizon, or is this just a good story for a video? To be honest with you, I'm not paid to make videos, so I don't really want a good story about the market. I want to know where it's going tomorrow because I want to make money at it, right? So I see a storm in the future. That's what I see. You know what I did today? So I own positions in 2 stocks. I'm long Skills and I'm short AppLovin. Now the good news is AppLovin went down and Skills went up today. So I made money on both my positions. It's great. Not a lot of money. Not a lot, but a little. But what I did is I don't think Skills is going up to 100 tomorrow morning. I think it's an undervalued, risky stock. By the way, let's see where Skills shows up in the model. By the way, I know where it shows up in the model, but let's look. Let's look. Maybe Jeffrey, you could teach us something that we didn't know. Skills. It's the 9th best stock. It's $92 million market cap. So it is the smallest market cap at the top of the list. That's good. It's got an expected return of 35%. It's got a really attractive Chicago Quantum Net score, and it's got a beta up by the moon. So it isn't cost much to get a big position, a big percentage of the company. It's number 9 out of 2,950 or whatever stocks. It's got a big expected return. Your money could do well here. So I sold covered calls. I sold them for 9 days from now. And so if the stock goes through the roof over the next 9 days, I lose all the upside over where I sold the covered call. $5. So the stock's at $4.46. If the stock goes above 5, I've just given away all the upside above 5. It's fine. I'm not going to worry about it. I made a few pennies. But it's because I see nervousness in the market. Now, I love my short position in AppLovin. Where's AppLovin? So AppLovin is number 175. It's actually a pretty good position. It's got a 25% expected return. It's got a beta of 2.1. It's got a value of $15 billion. You should not be able to manipulate this stock. It's a $15 billion stock. So a little safer. Probably not going to move as fast. I'm probably not going to get my short paid off in a day or a week even. It's a $15 billion stock. It doesn't move that fast. It's got a smaller beta, right? So maybe I'm a little less nervous, right? Because I'm short, I'm nervous by definition. So there you have it. That's where we're at. And well, thank you for watching. Hopefully you